Welcome to the Deep Dive, where we are cutting through the noise to understand the hidden architecture that, well, truly runs our digital financial lives. Today, we're focusing on a company that you've likely interacted with hundreds of times this year, maybe even this morning, if you checked a budgeting app or moved money to a brokerage account. And yet, you probably don't know its name.
It really is the ultimate story of invisible infrastructure.
Mm.
We're talking about Plaid. You have these massive consumer brands, right? Like Revolut or Venmo. They change what we do with our money. But Plaid came in and fundamentally changed how those apps are even allowed to access your financial data in the first place. They're the connective tissue.
That's the perfect way to put it. So our mission today is to explore how Plaid went from really a tiny startup just trying to make one app work to becoming this massive ecosystem builder. We'll get into the regulatory heat they faced, a huge blocked acquisition, and why, funnily enough, their independence ended up cementing their power. You're going to see why the invisible layers are so often the most valuable ones. Okay, let's start at the beginning. We're talking around 2013. The founders, Zach Parrott and William Hockey, they weren't aiming to build an infrastructure giant. They just wanted to build a simple budgeting app. But they hit a wall, a huge one. What was that specific painful obstacle that just stopped them cold?
They ran straight into the industry's biggest nightmare, total and utter fragmentation. You have to remember, the U.S. banking system back then, it just wasn't built for this new digital world. Every single bank had its own unique, often ancient back-end system. There was no common language, no standard way for an app to connect to a customer's bank data.
So if I'm a developer, say, building the next great FinTech app, and I want a user to link their bank account, what does that actually look like for me?
Oh, it was archaic. You'd have to build a completely custom integration for each and every bank. The sources describe it as slow, manual. We're talking weeks, sometimes months of engineering work just for one bank connection.
For one bank, and there are thousands in the U.S.
Exactly. So if you wanted to cover, say, 90% of the market, you were looking at building and maintaining hundreds of these fragile connections. It was a massive barrier to entry.
That's an impossible foundation for a startup that needs to move fast. And that was the aha moment, wasn't it? They realized the problem wasn't building a better app.
The problem was that the digital pipes, just didn't exist. So they pivoted hard. The real opportunity wasn't the app on the surface. It was building that missing infrastructure layer underneath. Their idea was, deceptively simple but revolutionary. Build one single API.
One API to do all the messy work.
Exactly. An API that connects developers to all the banks at once, that cleans up all the messy different data formats into something usable and creates a secure way to do it.
So they basically took on all of that complexity so that every other fintech startup didn't have to.
That's it. It completely changed the economics of launching a financial service. You can think about it like this. Plaid wanted to do for data what MasterCard did for payments, create a single universal standard. Or, maybe a more modern example, what India's UPI did for real-time transfers. They unified it. Plaid just did it as a private company because, well, no one else was.
And the timing here is it's perfect. They're building this right as the whole fintech wave is cresting in the early 2010s. You've got neobanks like Monzo and N26 popping up in Europe, mobile payments exploding in Asia. The whole world was shifting.
And that global shift created an expectation here in the U.S. Consumers suddenly wanted these smooth, instant digital experiences. And you had new companies like Robinhood, Acorns, Venmo, Coinbase. They were all trying to meet that demand. And they all had the exact same problem.
They needed to get access to customer bank accounts fast.
Fast, reliably, and securely. For onboarding new users, for verifying you have the money you say you have, for moving funds.
So Plaid was like the wind beneath their wings. Can you give me a concrete example, like for a Venmo or a Robinhood?
Sure. Think about linking your bank account. Before Plaid, you had to do those slow micro deposits where they send you like 7 cents and you have to wait days to verify it.
Right. Yeah, I remember that. It was awful.
Plaid made that instant. For a company like Coinbase, where you need secure, high-volume transfers to buy crypto, you need an integration that's rock solid. Plaid solved that core fragmentation problem, which let these companies scale at what the sources call unprecedented speed.
So the genius wasn't just solving a tech problem. It was solving a market problem right before that market just completely exploded.
Absolutely.
Yeah.
And that's how they got network dominance. The more fintechs used Plaid, the more valuable it became for banks to connect. And the more banks that connected, the more essential Plaid became for any new startup. It created this flywheel effect that became almost impossible for anyone else to compete with.
It's such a fascinating contrast to other countries, right? You see places like Brazil with PIX or Nigeria where the government eventually steps in and mandates some kind of centralized system.
That's the core difference. Plaid became the de facto national infrastructure layer for the U.S., not because of a government mandate, but because the market desperately needed it. They stepped into a vacuum and, basically solved it.
Okay, so this incredible growth, this control over access, it naturally led to some controversy, especially around how they were getting the data. Early on, they relied on something called credential-based data access. For our listener, we should probably clarify, what does that actually mean, and why were critics so worried?
It's a really critical point. Credential-based access, or, well, the less friendly term is screen scraping.
Yeah.
It meant that you, the user, would give your actual bank username and password to a third-party app. Plaid would then use those credentials to log into your bank's website, just like you would, and kind of scrape the data off the screen.
Wow. Okay, so right away, the concern is just massive data security risk. I mean, giving a third party your main banking password sounds terrifying.
It sounds terrifying, and that was the big criticism. Security was one thing, but also user control. Critics argued it was sort of a regulatory gray area. You had innovation that was just completely outrunning consumer protection. It was a bit like, what we saw in other rundowns like Kenya with the early mobile lending boom. The tech just moved way faster than the rules.
But Plaid's argument and their supporters' argument was that they were filling a void, right?
They were. They argued they were providing better security and standardization than if every single app tried to build its own scraper. And this all highlights how different the U.S. was. While this was happening, the European Union was implementing PSD2, which is a directive that forces banks to create secure, regulated APIs for this stuff. So it was moving away from screen scraping entirely. Australia did something similar. Plaid was just operating in a much wilder west.
And all of that tension, that power, it all came to a head in 2020. The Visa acquisition. A $5.3 billion offer. That moment could have completely reshaped digital finance.
Oh, absolutely. I mean, think about it. Visa, the giant that controls how money moves on cards,
Oh, yeah.
acquiring Plaid, the giant that controls access to the bank data itself, it would have created this unparalleled behemoth.
But the Department of Justice stepped in. They blocked the whole thing. Why? What was so uniquely anti-competitive about that merger?
The DOJ's argument was really about the future. They weren't just worried about market share today. They were worried about who controls innovation tomorrow. They saw Plaid as more than a data tool. They saw it as a potential future competitor to Visa's main business.
How so?
Well, through things like account-to-account payments, moving money directly between banks without ever touching Visa's card rails. If Visa bought Plaid, they could just, slow walk or even kill any innovation from fintechs that might threaten their card business. The DOJ basically said, Plaid is the main on-ramp to digital finance, and you can't let the guy who owns the toll road buy the on-ramp.
That's a powerful way to put it. It's not about size. It's about controlling what's possible in the future.
And that block was a defining moment. Because instead of collapsing, Plaid actually used its independence to just accelerate. Investors suddenly realized that an independent Plaid, one that wasn't tied to Visa's old business model, was actually way more valuable.
So how did they diversify? They clearly knew that just being the data guy wasn't enough for the long term.
That's right. They knew connectivity was just step one. So they started expanding into all the other problems their clients had. Things like identity verification, super important for KYC, or know your customer rules.
Yeah.
They moved into income verification, and then the big one, payment initiation,
All right.
actually helping to start account-to-account payments.
So this diversification, it sounds like it was both a reaction to the regulatory pressure and also them getting ready for what was next, like real-time payments.
It was essential adaptation. They had to start moving towards the regulated, secure API model that Europe's PSD2 was pushing for, even in the U.S. And yeah, they were absolutely looking at what was happening with national payment systems like Brazil's PIX and thinking, we need to be part of that. So Plaid evolved and went from a single API to this robust multi-service infrastructure platform.
And that pattern seems universal, where a key piece of infrastructure starts small and then just grows to become the backbone of the whole ecosystem.
It is the defining pattern of companies that last. You see it everywhere. M-Pesa in Kenya started as just a money transfer service. Now it's the national payments backbone. Grab in Singapore started with ride-hailing, and now it's a financial super app. And I think the core lesson for you, for the listener, is this. The consumer brands, they get all the headlines. But the real long-term sticky value, It's almost always in the pipes underneath the system. Plaid proved that enabling everyone else is often way more valuable than competing with them.
Plaid's story is just such a powerful lesson in strategic invisibility. This is a company that got huge by solving a fundamental infrastructural problem that nobody else wanted to touch.
Yeah.
And by doing that, they enabled, literally trillions of dollars in new financial activity. Infrastructure companies last because the whole system starts to depend on them.
And looking forward, their survival, their continued dominance is really going to depend on how they navigate three huge forces. First is that global move toward mandated open banking. They have to finish that shift away from the old methods to fully regulated APIs everywhere.
The second force would be the rise of real-time payments, right? Especially in the US now with FedNow.
Exactly. FedNow is a huge opportunity. It creates the rails for instant payments, and Plaid is sitting in the perfect spot to provide the verification and initiation services to make those transactions actually happen for millions of people.
And the third force, the one that's maybe the most transformative.
The evolution of digital identity. I mean, we've seen incredible systems built in places like Estonia or India with their Aadhaar system or the UAE. As money moves faster, proving who you are securely becomes so much more important. Plaid won't just be connecting bank accounts anymore. They'll need to connect our verified identities across everything.
Which leaves us with a final provocative thought for you to chew on. We spent this whole deep dive on how Plaid built the pipes to connect our financial accounts. But when you look at those global pioneers in digital identity, what third-party infrastructure is going to be needed to connect and secure our digital identities across everything? Not just finance, but healthcare, government services, education, as seamlessly as Plaid connects our banks. What company is going to become the Plaid of compliance and digital identity in the next decade? Something to think about.